Right now, the richest companies in the history of the world. I mean, companies that traditionally sit on just absolute mountains of cash, they're quietly maxing out their corporate credit cards.
Yeah, it's wild. It's a complete inversion of everything we know about tech finance.
It really is. So, welcome to our June 1st, 2026 deep dive.
Yeah.
Today, we are taking the stack of sources you provided, and we're looking at why Silicon Valley is suddenly going into this historic, unprecedented debt just to keep the AI lights on.
Right, because the focus has completely shifted, away from the shiny consumer-facing software that everyone sees.
Exactly. We've got a fascinating stack of materials to get through today. We are pulling from financial reporting in Tech Times, Investing.com, and Motley Fool. Plus, we've got this really eye-opening capital markets chart deck from MUFG.
Oh, and don't forget the market chatter around Alphabet and Warren Buffett.
Oh yeah, we are definitely getting to that. So the mission today is to uncover the hidden, massive, I guess you'd call it the picks and shovels infrastructure of this 2026 AI boom.
The plumbing, basically.
Right, the plumbing. We're going underground to look at these severe physical bottlenecks happening in the hardware. And the, frankly, terrifying bill that's coming due for all of it.
Because the contrast right now between the public perception of AI and the actual financial reality of it, I mean, it is just stark.
Okay, so let's unpack this.
Uh-huh.
Because if you ask almost anyone on the street who the big winner in AI is, they're going to say NVIDIA.
Oh, 100%. They're the poster child.
Right, they build the GPUs, the graphics processing units. But if you look at the numbers from Tech Times for this first half of 2026, NVIDIA stock is up, what, about 12% year to date?
Yeah, around 12%, which, is a solid return.
It's solid, sure.
Yeah.
But it reflects a company whose dominance is kind of already priced in, the really explosive triple-digit growth.
Yeah.
That is happening in the unglamorous plumbing you mentioned.
Exactly. I mean, we are seeing an optical component maker named Lumentum up 121%.
Wow.
Yeah. And a semiconductor equipment giant, Applied Materials, is up 67%.
Okay, let's actually focus on Lumentum for a second here, because I was thinking about this. And if NVIDIA is building the ultimate, million horsepower sports car engine.
Lumentum is building the physical highways.
Yes. And without the highways, that million horsepower engine is just sitting in a garage, idling.
Well, and the heat generated by that idling is exactly why historical data center architecture is essentially dead at this point.
Wait, what do you mean, Dad?
So for decades, data centers moved information over copper wires. But copper has physical limitations. When you try to pump the massive electrical signals required for AI through copper, it generates immense heat.
Right.
And more importantly, it causes latency. So signal delay over distance.
Which is a total deal breaker when you have like tens of thousands of processors that need to talk to each other in microseconds just to train a single AI model.
Exactly. Microseconds matter. So the industry basically had to physically abandon copper and shift entirely to optics.
Laser.
To lasers, right. So Lumentum manufactures the lasers, the transceivers, and the optical circuit switches. These take electrical data from a processor, convert it into pulses of light, beam that light across the data center through fiber optics, and then convert it back to electricity.
That sounds like sci-fi, but it's just how a server rack works now.
Yeah, because light travels faster, it uses a fraction of the power, and it provides the massive bandwidth that an AI cluster demands.
Well, here's the crazy part from the sources. Lumentum is basically telling the market, hey, we physically cannot manufacture these lasers fast enough.
Yeah, the demand is just overwhelming.
Their CEO actually stated they are undershipping customer demand by roughly 30% right now.
And that's even after expanding their manufacturing capacity by 40% last year.
Right. They still have a $400 million backlog just for their optical circuit switches. So what is the bottleneck here? Why can't they just, build another factory?
Well, what's fascinating here is the sheer delicacy of the physics involved. We're talking about silicon photonics.
Silicon photonics, okay.
Yeah. You are etching waveguides into silicon that are so microscopic that literally a single microscopic dust particle will ruin the entire wafer.
Oh, wow.
And then you have to physically align a microscopic laser to a fiber optic cable, and we're talking tolerances down to the submicron level.
So you can't just slap an assembly line together in a warehouse?
Not at all. It requires custom, hyper-specialized manufacturing environments. You absolutely cannot spin up a new line overnight.
And the bottleneck is so severe that NVIDIA itself couldn't just sit back and wait in line. Like in March of this year, NVIDIA poured $2 billion of its own money directly into Lumentum,
Right. The company building the engines had to go invest $2 billion in the highway paving company.
just to secure a multi-year supply agreement, just so their engines would actually have roads to drive on.
Which really brings us to this massive economic shift. We have moved entirely from a demand-constrained environment to a supply-constrained environment.
Meaning everyone wants it, but no one can get it.
Exactly. Look at the big four hyperscalers, Amazon, Alphabet, Meta, and Microsoft. They have a projected combined capital expenditure of $610 billion for 2026.
$610 billion in a single year.
Yeah, that is a 77% jump from 2025.
That is just an absolute fire hose of capital. And when a fire hose that large gets turned on, you get these massive physical backlogs.
Yeah.
Because you can't build these microscopic optical pathways or the chips themselves without fundamentally altering materials at the atomic level.
And that is a perfect segue to applied materials.
Right. Because if Lumentum makes the parts that connect the chips, Applied Materials makes the massive, super complex tools required to manufacture the chips themselves.
They're the world's largest supplier of front-end chip-making equipment. They handle the deposition, the etching, the ion implantation, all at the atomic level.
Okay, wait, before we move on, ion implantation, deposition. For those of us who don't have a PhD in solid-state physics, what are these machines actually doing?
Sure, yeah. Think of it like extreme 3D printing, but at the atomic scale. So deposition is the process of laying down an incredibly thin layer of material, sometimes just a few atoms thick, directly onto a silicon wafer. And then etching is using chemicals or plasma to carve microscopic canyons and circuitry into that ultra-thin layer.
Got it. And ion implantation.
That is literally using a particle accelerator to shoot charged atoms ions directly into the silicon crystal lattice.
You're kidding.
Yeah.
A particle accelerator in the factory.
Yep, and doing that changes how the silicon conducts electricity in highly specific areas. It is what actually creates the transistors.
That is wild. So Applied Materials builds the machines that perform these like atomic level surgeries.
Exactly.
So keeping with the food analogies, if NVIDIA chips are the gourmet meals of the AI world, Applied Materials is the company selling the commercial ovens, the titanium pans, the ventilation hoods to the kitchens making them.
That's a great way to put it. And because AI infrastructure demand is so immense right now, Applied Materials is forecasting their equipment market growth to be over 30% for 2026.
Yeah, the sources say they just posted a record $7.91 billion in quarterly revenue.
They did, though we do have to factor in the geopolitical reality surrounding those tools.
Right, the regulatory side of things.
Yeah, the reporting notes a very important regulatory dependency here. 27% of Applied Materials' total revenue in their second fiscal quarter actually came from China.
And the sources show they recently paid a $252.5 million settlement to the U.S. government.
Which is a massive settlement.
It is, and that was over allegations that they routed semiconductor manufacturing equipment, specifically those ion implanters we just talked about, through a South Korean subsidiary to a Chinese company called SMIC.
Right, and this happened after SMIC was placed on a U.S. restricted entity list.
So the government stepped in. Now, the investigations by the DOJ and SEC were closed without further action following the settlement, and the company agreed to strict compliance audits. But we bring this up to show how delicate these global supply chains really are.
Completely. You have this massive growth narrative driven by the AI supercycle, but the customer bases for these fundamental tools are deeply intertwined with complex, highly scrutinized global trade dynamics.
So, okay, Applied Materials builds these atomic-level foundries, and Lumentum builds the light-speed highways. But even with perfect tools and perfect highways, you run into the sheer laws of physics when the AI chips actually try to, think and remember.
Yes, the memory bottleneck.
Exactly. Which brings us to two huge heavyweights, Micron Technology and Broadcom.
This is where we see the physical constraints of computing power really manifesting in the financial markets.
I mean, Micron Technology recently crossed over into the highly exclusive $1 trillion market cap club.
$1 trillion. It's staggering.
And the reason why is just three letters, HBM, high bandwidth memory. According to the Investing.com report, the global supply for HBM is structurally sold out through the entirety of 2026.
Not just low stock, sold out. And to understand why this specific memory is sold out, we really have to look at what's called the memory wall.
The memory wall.
Yeah. So a GPU can process calculations at just blistering speeds, but it needs immediate, constant access to the data it's processing. Traditional memory architectures acted like a tiny straw.
Okay, I can picture that.
So the GPU was this giant beast starving for data, but it could only sip it slowly through that tiny straw.
Right, so it was basically starving the processor.
Exactly. High bandwidth memory turns that straw into a fire hose. It solves the physical distance problem by vertically stacking memory chips on top of each other and placing them incredibly close to the processor itself.
But stacking silicon isn't like stacking Legos, right?
Oh, far from it. To connect those stacked chips, manufacturers have to drill microscopic holes straight through the silicon, thousands of them, and fill them with copper to pass signals up and down the stack.
That sounds incredibly prone to breaking.
It's notoriously difficult. It's called a through-silicon via. It is incredibly resource-intensive, and the yield rates, the actual number of usable chips you get per batch are much, much lower than traditional memory.
And because it's so incredibly difficult to make, the few companies that can actually pull it off are seeing returns that are just mind-boggling. I mean, Micron's fiscal Q2 revenue was up 196% year over year.
Which is incredible on its own.
But here is the stat from the sources that literally made me do a double take. For their upcoming quarter, they are guiding for a gross margin of 81%.
Yeah, that number is almost unheard of in hardware. An 81% gross margin on physical goods indicates an environment of absolute pricing power.
Because everyone is desperate.
Exactly. When supply is completely sold out on multi-year contracts, the manufacturer gets to dictate the terms. Micron is using that massive windfall to aggressively expand. I mean, they're currently building a $100 billion fabrication campus in New York.
Right. And here's where it gets really interesting, though, and I want to push back a little on this massive expansion. We are talking about $100 billion bets on specific hardware architectures. So let's bring Broadcom into the conversation.
Broadcom is a fascinating piece of this puzzle.
Because Broadcom dominates a specific type of chip called an ASIC, or Application-Specific Integrated Circuit. They hold 60% of that market.
And the distinction between a general GPU and an ASIC is really critical right now.
Yeah, the way I see it, if a general CPU or GPU is like a Swiss Army knife, it can do a little bit of everything. An ASIC is a highly specific, custom-designed scalpel.
It does one exact mathematical task incredibly fast and uses very little power.
Exactly. And the Motley Fool source points out this major shift in the AI industry. For the last few years, it was all about training the AI models, right? Having the AI read the whole library.
Right, the learning phase.
But now the shift is toward inference, which is actually asking the trained AI a specific question and getting an answer. Inference now takes up 2/3 of all AI computing power in data centers.
And ASICs are just far more efficient, both in terms of speed and power consumption, for those inference tasks than general-purpose GPUs.
So here is my pushback. If the architecture of AI computing is shifting so rapidly from training to inference, and companies are moving toward these highly specific scalpel chips like ASICs, isn't a $100 billion factory for a specific type of HBM memory a massive gamble?
You mean, what if the tech moves on?
Yeah. What happens if the AI architecture fundamentally changes in 2 years and we suddenly don't need these exact memory nodes anymore? Aren't they left holding an empty $100 billion bag?
I mean, it sounds like a gamble on the surface, but you really have to look at the structure of these deals. Micron isn't building a $100 billion fab on speculation.
They're not.
No, they are building it backed by massive, multi-year, locked-in contracts from hyperscalers who know their baseline inference demands are only going up. Because even inference requires vast amounts of memory to hold the model parameters active.
Okay, but memory is historically a very cyclical industry.
And that is the real risk the market is weighing right now. The risk isn't an overnight architectural obsolescence. The risk is the moment when the memory market inevitably reequilibrates.
When supply finally catches up.
Exactly. Right now, Micron has 81% margins because everyone is desperate. But companies like SK Hynix and Samsung are also racing to build out their capacity.
Right.
So when they inevitably flood the market with new HBM supply in, say, 2027 or 2028, that 81% pricing power evaporates. The capital expenditure for the factory is locked in, but the future profit margins are suddenly squeezed.
Wow. Okay, so you just outlined $2 billion for lasers, a $100 billion memory campus, and hyperscalers spending $610 billion in a single year. The natural, unavoidable next question is, where on earth is all this money coming from?
This is where we have to look at that MUFG capital markets chart deck, because it outlines what is honestly one of the most significant structural shifts in modern corporate finance.
It really is, because up until now, the story of big tech, your Apples, your Alphabets, your Microsofts, was that they were essentially giant piggy banks.
Right. They generated massive cash from software subscriptions and iPhones.
And they just paid for whatever they wanted in cash. But the sources show that era is over. For the first time, this $600 billion hyperscaler Capex is entirely outpacing their internal free cash flow.
Which is wild when you think about it. Free cash flow is the actual cash left in the register after paying all the operational bills and baseline expenses.
The profit they can actually spend.
Exactly. Historically, these tech giants had tens of billions just sitting in the register. They physically couldn't deploy it fast enough. But the sheer physical scale of this AI infrastructure build-out has emptied the register.
They are out-of-pocket change.
Totally. They are now spending more on lasers, atomic-level foundries, and data centers than they are bringing in through the door.
So what does this all mean? It means the richest, most cash-flush companies in human history are suddenly having to max out the corporate credit cards.
Yeah.
They're literally taking out massive corporate mortgages just to keep playing the AI game.
And the transition from self-funded expansion to a sustained reliance on debt markets, it's staggering in its speed. The data shows over $200 billion in big tech AI bond issuance in 2025 alone.
$200 billion in just 1 year of bonds.
Yes. They have become the dominant new source of supply in the entire global credit market.
The market chatter we reviewed showed Alphabet, Google's parent company, literally raising $80 billion right now, specifically for AI expansion. And Warren Buffett's Berkshire Hathaway is stepping in to back $10 billion of it.
Yeah. When Warren Buffett is acting as the local bank for Google to buy AI servers, you know the financial landscape has fundamentally shifted.
Completely.
And this shift impacts almost every investor. The MUFG data highlights that AI-related sectors, which includes the tech companies issuing the debt, the utilities powering the data centers, the electronics makers, they now make up a massive 18% of the entire global investment-grade bond index.
Wait, 18%. So even if you think you're just holding a safe, boring bond mutual fund in your 401k, you are effectively funding the AI infrastructure build-out.
Exactly. You've got nearly a 1 in 5 exposure to this specific tech cycle without even trying.
That is unsettling. And the credit market is starting to price in the anxiety about the sheer size of this debt, right? We see this really clearly in the data regarding Oracle's credit default swaps.
Ah, yes, the Oracle warning sign.
Yeah. Our sources show that Oracle's 5-year credit default swap, or CDS, has tripled since September. Walk us through how a CDS actually prices in that anxiety.
Sure. So a credit default swap is essentially a specialized insurance policy.
Okay.
If you own Oracle's corporate bonds and you're worried they might default on that debt, you buy a CDS to protect yourself. You pay a premium for that insurance.
So if I think they are going to crash, my premium goes up.
Exactly. So when the price of that premium triples in less than a year, it means the broader market smells smoke. Investors are demanding much higher compensation to take on Oracle's risk.
And why is the market smelling smoke around Oracle specifically?
Well, the source notes it's because of their highly debt-funded AI build-out, but combined with a heavily concentrated customer risk.
Because they are overwhelmingly reliant on OpenAI.
Right. They are borrowing billions upon billions to build data centers tailored for one very specific, very demanding client. If OpenAI pivots or stalls out, Oracle is left holding a very, very expensive bag.
That makes a lot of sense.
But if we connect this to the bigger picture, it is really important to contextualize the borrowing of the top-tier hyperscalers so we understand the true systemic risk here.
To kind of talk everyone off the ledge.
Right, right. Because the raw dollar amounts are historically unprecedented, yes. But the MUFG data shows that despite this massive $200 billion borrowing spree, the aggregate liability-to-asset ratio for the major hyperscalers is still only 48%.
Meaning their total debts only equal about half of their total assets.
Exactly. And compare that to the broader S&P 500, the average company in the index sits steadily at a liability-to-asset ratio of around 80%.
Wow. Okay, so big tech is tapping the debt markets in a way they never have before, but their balance sheets are still uniquely strong compared to almost any other sector of the economy.
And
They're taking out a huge mortgage, but they also already own half the neighborhood in cash.
that's a perfect analogy.
Well, we've covered an immense amount of ground today, peeling back the layers of this AI phenomenon. To summarize the journey we've taken, the true story of AI in 2026 is not just about the software or the chat interface. It is fundamentally a story of severe physical constraints.
Absolutely.
It's about Lumentum struggling with the delicate physics of silicon photonics, unable to manufacture optical lasers fast enough to meet demand. It's a trillion-dollar scramble where companies like Micron are drilling microscopic holes through stacked silicon to create memory, and they're enjoying 80% margins because the supply is just structurally sold out.
And the debt.
Right. And perhaps most importantly, it's about a historic pivot where Silicon Valley has emptied its own massive cash registers and had to tap Wall Street's debt markets just to keep the data centers running.
And the reason this matters to you, the listener, is profound. Because even if you don't actively trade shares of NVIDIA or Lumentum or Applied Materials, this massive infrastructural shift is dominating the global credit markets.
Yeah, it's everywhere.
The borrowing required to sustain this boom is reshaping the entire economy's borrowing landscape. It's heavily weighting everyday bond indexes and influencing interest rate dynamics worldwide.
Which leaves us with a lingering question, one that brings us right back to those massive corporate mortgages. If these hyperscalers are taking out hundreds of billions of dollars in debt bonds with 5 to 10-year maturities to pour the concrete, lay the lasers, and build the physical foundation for this AI infrastructure,
Yeah.
what happens to the global economy if the actual return on investment from AI takes 15 years to materialize? What if the companies selling the physical picks, the shovels, the lasers, and the atomic-level ovens end up vastly outlasting the digital gold rush itself?
That is the multi-trillion-dollar question.
It really is. Keep exploring that physical foundation. Keep questioning the infrastructure beneath the software. And thanks for joining us on this deep dive.